Hello everybody, welcome to the second episode of Minimal's Maximal Show. I'm Minimal Dan, and today we're going to talk about how to think about long volatility in markets and in life. So I was inspired by a video in Real Vision about long volatility with Chris Cole. He manages Artemis Capital. He unpacked like tons of ideas. I highly recommend it. I thought I wanted to make a video and review some of his ideas and not some of my ideas, and hopefully you guys found it useful. So let's unpack this. So before we start, we gotta define some things because not everybody's like a sophisticated trader. So I wanna make this video available for everybody. So I love this quote by Chris Cole. He says, "Volatility is the instrument of truth." And when you think about it, before I was thinking in terms of different asset classes that you have, like bonds, stocks, real estate, and so on. But really, you just have long vol and short vol because either prices go up or they go down, right? So very interesting. So anyways, let's start with defining what is an option, because in options you have convexity, and it'll help you use this strategy so that you can protect your portfolio from tail risk. So what is an option? An option is a contract which gives the buyer, which is the owner or holder of the option, the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. So we'll go through some examples. What is volatility? So volatility is the degree of variation of a trading price series over time, usually measured by the standard deviation of logarithmic returns. So what it's saying is that, as you can see in this graph, as volatility increases, the probability of outcomes widens, right? So it gets harder to know the future price of a stock because the volatility will be too wide, like in 2008. So when you have a low vol regime like this, it's very easy to buy anything, look like a genius. But when volatility spikes like 80, all the assets, all the correlations will go to 1, and every asset class pretty much starts to fall. That's what happens. And early this year, in March, when volatility spiked so high that even gold, even bonds, safe assets, all went down at the same time. But what if you were long volatility? What if, so the VIX basically goes, it's uncorrelated to the S&P 500, right? So when the S&P 500 is the 500 biggest companies in the US, and when they go up, volatility tends to go down. Not always, but it's a good rule of thumb. So here, when the S&P, with the volatility spike, all the stocks and all their assets started falling, right? So if you were long volatility, it's like buying insurance, right? You pay a premium in advance in case your house burns. If it burns, then the insurance will give you money. So the problem here is liquidity. So when you're full invested, you have no cash, and all your assets fall at the same time, then you need to sell the ones that did good to pay for the ones that are going really down, especially if you're all averaged up. So when you have options, and let's say you bought a call option, I'll explain in a second what it is, on the VIX, this thing will spike so much that now you'll have money, because if you sell the call, if you exercise the call, you can use now those profits to do other things in your portfolio. So that's the advantage of being long volatility. So this is what I was trying to explain, that the S&P 500 goes down when volatility spikes. So there's different rules. But when the VIX is below around 26, it's kind of choppy. You can go long and short. When it's like below 15, it's just very easy. Anybody can look like a genius. Above 40 is very tough. Most people lose money. So we're going through a regime of very low volatility, like you can see here, and then here, sort of. And we may return to a period where we're going to have a lot of high volatility. So it's going to be very hard to trade or invest. Okay, so I think I made the point. Same thing happened in 2008. You see it spikes and this falls here. I want to be repetitive. So what's a long call option? Basically, this is your premium. So let's say you pay for the contract, $10. So that's your premium for 100 of them, right? Because it goes in hundreds, and then in units of 100, and then so you have your payoff as it goes up. Once you reach this line, that's your break-even point. If it keeps going up, now it turns into profits. So options have convexity, and that's why they can go up a lot in price, because you have 100 times your lever basically. So when you buy the VIX, let's say we're gonna do an exercise on the VIX, what will happen the next, you're nervous about elections, you're nervous about things that are doing really good, all-time highs. You can buy calls on the VIX and maybe use 5% of your portfolio, returns, put them in VIX calls, and they can go 4 times up, and then you can protect some of the things that may go down if there's a sell-off. So that's a way to protect yourself, like buying insurance, right? So here is also call option and put option. So you can also buy put options, and you're betting on the other side. So let's say you bought put options on banks, and banks and small caps tend to go really down when there's a sell-off. So you buy, let's say, an index of the Russell 2000, it goes down, and then you make money on the downside. So what is long? Oh, okay, before we get there, let's do the example. So here. So I'm in my E-Trade account. This is the symbol VXX. This is how it looks, option chain. So let's say we're nervous about this year. So elections November 20. The strike price is, so it's trading at 24. So we'll buy them. You have options that are at the money, deep out of the money. So at the money will be like 24.60. So we want to buy them like higher, because the VIX can go up to 40, 50, 60. So it's not really priced in. So you can benefit from that convexity. So you buy maybe at 31. And you can use calculations like the Black-Scholes or the Monte Carlo simulation and get, that's how you actually do it. We're not going to go through this. It's not an option class. I just want you to to learn how to think about options. And then you do like buy, and then you say, well, let's buy, let's say 4. And then you want to do we want to do a call, right? Because it's inverted, right? When the VIX spikes, the stocks go down, so we want to go even higher. And then we're going to go to, let's say, well, we already picked it. So let's see, market. November. So one contract is 465, right? Because it's 4.6 times 100. So it's 465, right? You have 100 of them with 1 unit. So let's say you have $100,000 portfolio or $1 million, let's say 100 just for easy numbers. So you buy maybe 12, I think that's $4,000. Okay, so you buy like 5%, like 11. Okay, so roughly that's 5% of your portfolio. And let's say the price really shoots up to 65. So from 24 goes up to 65. So your return will be like, 2, 3, maybe 4x. Now this 5,000 become 20,000. And if the market falls a lot, you can, act like an insurance. So that's how I think about options. I try to trade a little bit of it just when I see that there's a lot of complacency. People are just so relaxed and these are cheaper. I buy them. And, sometimes they pay off even faster because you have time decay. So the sooner that the price shoots, the higher your return because you have time decay. Time decay, that's why it's convex. Okay, so enough of that, because this is not an option class. It's just just basic concepts. There's tons of videos on you can. So how do you reduce like your premium, because they get very expensive, like $400. You can do straddles. You can do all kinds of strategies to reduce your premium. And this video, I really wanted to talk more about some of my ideas. So I thought it was really cool when we tried to explain long volatility, Chris Cole, and he was talking about how you can benefit from change. So I was thinking, there's all these protests and craziness right now. So if you're in New York City like I am, and there's riots, maybe taxes will increase, maybe the rich are leaving, maybe you feel like things will get bad, maybe it's better to move to a place far away from the city. So in that way, if there's chaos, you're not harmed by it. You actually benefit from it because you're working outside from the city and you benefit from change. So that means you're long volatility. Another example is that you love carbs and you take the pain of not eating them. And then over time, you lose weight. And then you get, healthier and healthier over time. Same thing with, like, let's say you take the time to meditate, so that, an hour pain, maybe it's not the right word here, but you take like an hour, 2 hours, that's your premium that you're paying to meditate. Over time, you have more focus, more clarity. So that's being long volatility. You pay a small premium for a future benefit in the change, right? So let's say you are exercising. So you lift weights or you go running, that's your premium. And then here's when you start seeing gaining more energy, and over time you have tons of energy and you just feel good about yourself. So that's a way to think about long volatility. So how can you be long vol? I want you to ask your question. How you can be long volatility? How can you pay a premium now so that in the future I'm better off? How can I protect myself from those shocks and the tails of the distribution, which we're going to talk about? So the other thing I want to mention in this video is that a lot of people look at, they always look at averages. And in finance, I remember in class, it's always the 200-day moving average, the 50-day. And life is really about extremes from left to right, So I try not to focus too much on averages. I'm more concerned about the tails. If I get the tails correct, if I'm protected from the tails, my portfolio is not going to blow up, I'm not going to, be in a place where I'm going to get killed because I was planning to prevent that, okay? Just being dramatic. So in the book of The Black Swan by Nassim Taleb, he talks about tail risk, which is, let's say, the stock market crashes. So a lot of economists, they use this, the variable is the well-being of the turkey. So he makes an allegory for Thanksgiving, November, I think 26. So the turkey, the turkey's, things like, because I bring it food and it's getting fatter and fatter, so he's happy. He's like, oh my God, look at that. It's, I feel like this guy's so nice bringing me food. Everything is good. So if we were to forecast his life based on the past, everything looks good. The past, 200 days, 400 days. If you try to make a forecast from that, it looks like his life is gonna be even better. And that's what happens with a lot of stocks. They make these assumptions, linear assumptions, particularly from the top. And they think they always go to the sky. And so the turkey keeps going up, getting fatter, 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 fatter. And this is Thanksgiving. And obviously he is dead and I'm going to eat it. So that's the surprise. And that's the tail risk. That's what happens when you have all your money in the S&P 500 and it blows up and it goes down a lot. So he wrote in the book, a turkey before and after Thanksgiving. The history of a process over 1,000 days tells you nothing about what is to happen next. This naive projection of the future from the past can be applied to anything. So this changed my life. This book was just like, It sounds like very simple, very obvious, but we focus so much on like balance and normality, and we forget that there's a lot of chaos around, and if we're more aware of the left and the right risk, I think we'll be better off in our lives and decisions we make, sometimes even with people. So thinking in terms of volatility and terms of left tail risk and right tail risk is very useful. So an example of right tail risk will be the next. So a lot of portfolios that assume like things are gonna be balanced and they're gonna keep going up like the past 30 years. But usually things tend to revert back to the mean. So I think that maybe you're gonna return back to a chaotic time, because countries have so much debt. And usually when you acquire too much debt, there's gotta be a release valve. Either they default on the debt, which will be left tail risk, or they sacrifice the currency, which will be the right side of the tail, right? So that will be, a lot of inflation, stagflation, or even hyperinflation. So how do you protect your portfolio? How do you think about this? So I've been reading a book about revisiting Big Debt Crisis by Ray Dalio, one of my favorites. And I'm reading about inflation and hyperinflation in the 1920s in Germany. So the price of a loaf of bread went from 250 marks in January 1923 to 200 trillion in November. And this is the rate of inflation, the CPI, so that's 10 billion. So we're talking about crazy numbers. So that's why I like gold, because gold is convex. It has that convex payoff, meaning that if you get hyperinflation, gold will go up like this, like a jet. So that's why I like gold, maybe Bitcoin. And again, this is not investment advice. This is just entertainment, okay? So you gotta do your own research. I'm just speaking my mind out. So I'm gonna read a part from this book that I thought it was really cool. It says, from July 1922 until November 1923, the market depreciated by 99.9999997% versus the dollar. The cost of dollars increased 1,570 billion%. And prices rose by 387 billion%. For some perspective on what these numbers mean, in 1913, a total of 6 billion marks circulated as currency and coin in the whole German economy. By late October 1923, the entire stock of money in 1913 will just about get you 1 kilo loaf of bread. Living through such a chaos was immensely painful and traumatizing for German citizens, and experiences of the inflation will later serve to validate many of the criticisms made by Nazi politicians of the disastrous Weimar era. So, something to think about. So, this is another way to think about it. This is, most people buy stocks and bonds, and it's like in the middle and everybody's happy, things keep going up and up. But are they gonna keep doing that? Are we prepared for several losses of tail risk in the stock market, or are we ready for inflation? Are you ready? Ask yourself that question. Is your portfolio ready? Are you ready? Are you long vol? Thank you.